I'm Bill Baruch, president of Blue Line Capital, and I'm here with our analyst, Jannis Meindl, and we have a special episode today for you on the Triple Play podcast. If you notice behind me, this sign, Trade Like a Champion Today, if you watch our videos, Blue Line Futures videos, you'll know this sign is from Phil Streeple's office, my partner in our branch office down in Florida at Miramar Beach. So I'm down here on vacation with the family, but I'm always watching these markets and love getting information out. So we're coming to you today with this podcast, and Phil writes an article on metals every Friday. Gets posted on Kitco, and we post it on our websites, on Blue Line Futures website, so check it out. But he writes an article every Friday, does also our Metals Edge video. And so we thought no better than to do a podcast covering miners. We got a gold miner, a silver miner, as well as a copper miner here for you today. So let's dive in. First off, as you know, we'll start off with the macro. Jannis, take it away.
Thanks, Bill. So, we'll start off with the macro as always, of course. And looking back on last week, we got CPI data, also got PPI. But kicking it off with the 5% year-over-year print, which was a continued deceleration on CPI. And then if you look at some of the underlying components, which we are always watching because you want to see what moves behind the data. And there you can see that on the month-to-month print, which only came in at 0.1 in March, you had substantial deflation on the energy side. No surprise there because we had that flush below $70 in crude oil. That contributed negative 24 basis points. The positive contributors are the ones that we suspected to begin with, and really that ones that should contribute eventually to the deceleration of inflation here as we look to the out months. It was again shelter contributing about 17 basis points on the upside. And then if we look on the year-over-year contribution to that 5% headline inflation print, 2.7% of that is still shelter. So the renewed rents are rolling over drastically. So eventually you'll also see that spill over into the official CPI data. And then just the one component that the Fed's always been watching, and that's really been most concerning coming into this inflationary period that got the spot rolling. We're watching the CPI core less shelter, which is really an indication for wage price dynamics in the economy. And that contribution is also rolling over. So on the wage side, really encouraging, while we are already seeing those positive real wage gains, which should keep the consumer spending here, at least for the foreseeable future. And then just turning our eyes real quick here to PPI, came in at 2.7. So that's already right in line with the Fed's 2% average inflation goal. Again, if you look at some of the subcomponents, quite encouraging again on the PPI. So inflation data heading in the right direction. Bill, I'll let you cover some of the other data that we got and what that means for the Fed.
Yeah, thanks, Jannis. And I'll pick it up right where you left off there. PPI, I always say it's producer prices are a leading indicator of consumer prices, and that's important to know. As you see PPI roll over, import price index quietly last Friday was also contracted for the second month in a row. Prices from producers are coming in pretty sharply now. You're starting to see some of that into the CPI data, but quietly, not so quietly, last Friday was the Michigan consumer sentiment data, and that inflation expectations 1 year rose from 3.6% in March to 4.6% in here in April in this current month, and they're looking for 3.7. So this is a really big surprise, and it definitely the Fed's narrative has been, inflation expectations are a self-fulfilling prophecy. If you expect inflation to be higher, for instance, from the most simple fact, if you know gasoline is going to be higher next week, you're going to fill your car up today, that's going to drive prices higher. So the Fed is concerned about that. So that data set cannot go unnoticed. Well, final numbers next week on Michigan consumer data for the month of April. If that hangs up there, it's going to continue to leave a mark. But there are some, like you mentioned, rents and shelter rolling over. The services hasn't expanded in levels of the 3-month and 6-month trend. It's lower than that. So there's definitely some solid things to write home about here with inflation, and that's been our narrative. But I'm not ignoring that Michigan consumer number. That is something that could continue to poke its head out. Everybody's booking their summer vacation, and the prices, the real prices people are saying, are not coming down. Also, at this month, start of the month of April. So the big spike higher with that out of the OPEC production cut in crude oil moving higher. Gasoline prices going to trend higher seasonally as well this time of year heading into Memorial Weekend. So it's in the back of consumers' minds that the prices haven't come down and are likely only going to trend a little bit higher, making that impact. Now, because of that, you've also seen the Federal Reserve not back down from more work to do, more work to do, more work to do. Every single committee member coming out and saying that there's more work to do. Now that leads into the May 3rd rate hike expectations. And it's basically a foregone conclusion that they're going to hike rates. One more 25 basis point hike there in May. Now we'll start getting more data from there. That's what I'm watching very closely as we head into that. And we have a blackout period. It starts Saturday. Do we hear any more comments that are going to be hawkish, continue to rate, maybe make a buy the rumor, sell the news for the dollar and rates? They press the dollar higher into that meeting. But also due to some of the data, if it doesn't roll over like we saw with CPI and PPI last week, then you have the non-farm payroll right after the Fed meeting and the May 3rd. Then you have CPI in a week and a half later. So there's a lot more to digest before the June meeting. And I'm watching those June rate hike expectations. They got as high for another quarter point. So a quarter here in May and a quarter in June. Got as high as 30% probability yesterday. It's back down to 25% today after the Philly Fed was a big miss. But I'm watching those very closely. Those probabilities pick back up, and we could see that, potentially as the conversation gets going, get up to 50% or so. Market's going to digest that. The dollar's going to digest that. Inflation around the world this week as well. You saw from the UK was higher. You also saw from the Eurozone a bit higher. So continues to hear hawkish narrative as well around the globe, and that could drive up rates a bit too. So keep an eye on that. That's where my mind is right now. That's what I'm watching very closely, and that brings us to rate conversation brings us to gold. I mean, and here's we got these miners here for you today, but let's start off with a little bit of an overview of gold and some of the underlying commodities and what they've been doing with real yields. Gold has battled extremely well. Obviously, going back to November of last year, it bottomed out, just below 1,700 one more time. But the rally place in 2000 has been moving gold, and that's happened despite real yields remaining somewhat high. And I think though as those real yields, the difference between the 10-year yield and inflation expectations 10 years out. As that expanded, that should be a headwind to gold. That's probably why gold was lower. But what you're seeing the market really extrapolate out now is that all these central banks around the world, including obviously the Fed, hiking rates just steadfastly. They're going to slow growth. They're going to overhike and they're going to slow growth. At some point, they're going to have to pick this pedal, the foot the pedal, and then reverse action. And that's what gold is sniffing out here on this move. Obviously seeing things start to break, like the banking crisis. But not only that, central banks themselves in 2022 purchased 1,136 tons of gold. That's the most gold bought by central banks on record in 2022. And 2023 is off to a great start too. The strongest start in these first 3 months since 2010. And we know what happened, what really started getting gold going in 2010. That was laying the groundwork for that move to 1900. So there is, we got Turkey, China, India, largest buyers of gold. I mean, those countries are continuing to. I don't see a reason for them to stop buying gold. So that's going to underpin price and mindset. Not only that, the production of things like silver are well off the peaks, and we'll cover that within silver. And then the other thing that I watch very closely, if you read my stuff, if you watch my stuff, I always talk about the Chinese yuan and the impact of a weakening yuan on the metals. When it's lower, it can really drag the metals lower. And then when the yuan strengthens against the dollar, it's a tailwind to the metals. And we look at China as a terrific tailwind here as we get into the later part of this year. The reopening really hasn't begun. And you get the reopening news to start the year. And that was a big move for copper early part of the year, but the reopening really hasn't begun yet. The general public reasserting themselves into the society again after 2 to 3 years of lockdowns. I mean, it's going to have a big impact. New loans data has, as of last week, was the second highest on record behind January. The Chinese regulators as well are going to be a tailwind to promoting growth. So China consumes 50% of the world's copper, and that I think is important to know. In watching China and watching these metals and trading these metals. So that's a great. I don't want to steal the whole show here for you, Jannis. Why don't you hop in? What's your take on this?
I would echo all these points, and just to follow on the China tailwind here, that could really kick in here in the back half of this year. I mean, this has always been a question of we first saw the Chinese tech crackdowns with the CCP getting more involved, then of course you see business confidence that fell out of bed. With the lockdowns, consumer confidence fell out of bed with it. And right now we're really coming out of this 2.5, 3 year period where the Chinese consumers coming back. You still see a lot of news articles that a lot of consumers are still somewhat doubtful about the extent to which they will be allowed to return to normalcy. But eventually, as the Chinese consumer has saved tremendous amounts of savings here over the course of the last couple of years, you will see that demand come back in. And most importantly, the Chinese real estate sector has really been the growth engine for the economy and therefore the world's copper consumption. And so that will be key to watch. We saw the Evergrande instance where that real estate developer basically went out of business. I think their bonds are trading at somewhere near 70 cents on the dollar right now. But stabilization in that space is key so you can see consumer confidence return, because you have to remember that a lot of Chinese have all their savings invested in real estate. So if that doesn't stabilize, then you will not see consumer confidence returns. But right now we're seeing that. And as a result, we saw Chinese retail sales rising 10.6% in March. You also saw industrial production rise 3.9% in March with it. And you did see, after I think 20 consecutive declines in Chinese home prices, you did see an increase in home prices on a month-to-month basis in February, but also March by 0.5%. So we are watching that real closely, and watching along with that consumption trend, we need to watch the supply side and the fact that the world's largest copper producer, Chile, is producing 14% below the 5-quarterly average on their own copper production. You did see with the Chilean government, the new Chilean government under Boric, who came in and then proposed a new constitution that would have been extremely bad for copper production. And I think you see some of that trend, although the constitution itself did not get through last year, but you still see that the Chilean government is rejecting different iron mine projects. And as a result, the public copper miners are not nearly as confident as maybe they once were. You also see that a lot of the permits only last until 2030. And as we know, if from initiation of a project until you get to production, that lasts somewhere in the range from 10 to 20 years. So if you only have that permit until 2030, of course, you will not commit a lot of capital. So watching that Chilean production rather closely, also watching Peruvian production, and along with that, really the Congo has been the only region that has seen drastic production increases by about 120% up today from 2014 to 2017 levels. Bill, I'll kick it back to you, and we'll start it off with the first one.
Yeah, let's jump in. Here. Agnico Eagle Mines, a gold miner here. And one of the nice things with our theme of all the stocks, all the companies that we've been covering, we like to see the trailing 12 months higher than the next 12 months of PE. The multiple, and that's right here. So trailing 38, forward 12 is 30. That's terrific. Revenue growth, 46% in quarter four 2022. EBITDA growth of 45%. Net income growth of 66%. That's a little of a deceleration, but as you know, those numbers are strong. I mean, still strong. Price to book is 1.6. Compared to Newmont, price to book is 2. So it's a little bit cheaper there. The thing to also kind of keep in mind, as we look at these companies, they're volatile, and then if gold really needs to continue to kind of at least stay at this level, these companies can perform pretty well. And now the Agnico has invested a lot of capex. I mean, they have a lot of acquisition costs compared to some of the others, and that's really what you're going to be paying for, a little higher multiple there as well. But compared to 2011, 2014, the reinvestment back in the business has now declined from 92% to 51%. That's something that is a good thing to know when looking to buy this company or buy this stock, invest in it. The capex is coming down. We've covered things like that at times with like an AT&T, where an unloved name, and just like these miners have fallen out of love at times, and the 5G costs like at AT&T comes off. There's really more room for revenue growth right there and profits. And that's something you can see potentially here from these miners. Free cash flow yield has improved compared to prior periods at 11 now, but it is below the Newmont and Barrick at 19 and 18% respectively. So something to really kind of keep in mind that they're bringing the numbers in. I think there's a lot to look forward here. I think this can continue to improve. What's your take, Jannis?
Yeah, it's exactly what you said. With these miners, you have to watch that these are ultimately commodity plays. So, in and of itself, you don't buy these names because you think these are operationally exceptional businesses, because most of the time they are not. So, you got to watch out for that. And if that is a commodity play, if you have a view on gold, as we do here at Blue Line Capital, then you need to watch which of these miners is ultimately going to profit the most if gold rallies, if the underlying commodity trends in the right direction. And ultimately, it's going to be the name that has the most reserves, because the value of that business is ultimately the reserves that they have. So if you look at gold reserves from Agnico, that has increased by 1,255% since 2011. It's only increased it's decreased from Newmont by 11%, and Barrick's gold reserves have also declined by 58% since 2011. And then if you look at the gold reserves quality, ultimately, if you have ore that's coming out of the ground and you process that, you have a certain percentage of gold that's in that ore. And the reserves quality has trended lower pretty much across the space, although it's increased as far as Barrick Gold is concerned. But they have also shed a lot of gold assets, so they have really focused on those higher quality mines. But yeah, as reserves have increased, and as maybe Agnico has taken on somewhat lower quality reserves here, the quality of those have gone down. And then key to watch, especially as we talk about reserves, is the fact that Agnico has increased gold production by 218% since 2011. Newmont's production has only increased by 15%, and Barrick Gold's gold production has decreased by 46%. So if you want to go into that space and you want to watch what metric sort of is the most important, looking outside of PE ratios of the traditional financial metrics, then you want to watch the businesses that have reinvested in the past and that are set to take advantage of that past reinvestment, because ultimately businesses are a business value is the free cash flows that you can discount from the future. So Agnico definitely falls into that category, and that's what we're watching as far as the reserves go. Bill, I'll kick it back to you for the charts.
Yeah, I think it's a really good point, and I'll bring up too. We do at Blue Line Futures thematically. If you're in Blue Line Capital, futures, obviously we're trading gold and silver and copper every day. But at Blue Line Capital, we thematically rotate in securities within a securities bucket. We plan to launch a mining fund at later this year, the turn of the year. So keep an eye out for that. Contact us. For now, we do have exposure to miners and portfolios, and really an emphasis on gold miners. 60-40 blend portfolios, 3.5%. Aggressive 80-20 portfolios. We're invested into 4% into miners. We're currently using a fund for that, and we might layer some different exposure on. But as of right now, we don't own individual miners. However, what we do plan on doing, again, we plan on launching a thematically sort of mining portfolio, and so keep an eye out for that. Ping us about that if you have any interest in that too. But what I will say, take a look at this chart. To wrap it up here, Agnico, big support, big bottom, very similar to gold, and that's the reason really why we're very bullish in metals. We think the miners have a lot of room to go. When gold can eventually break out here, and much of that reason, really, look at this big bottom, big base out of here, and we got this little bit of a downtrend break. It's still some headwinds. The 50-week moving average. 382 retracement, 50% retracement. So there's still some room to kind of dig through here. But man, if we can get that breakout of that 2011 high and gold, it already has done it, but 2011 high like an Agnico, there's a lot of room here, and that's one of the reasons why we're really excited about the miner space. And let's move on though. First, Majestic. And you said it in the last conversation, on Agnico was you're not buying these, because these are really exceptional companies, and silver miners more than anything. These companies they reinvest more than what they bring in. Many times, very high multiples. In fact, the average multiple in the silver mining space is 136. First Majestic lost money, and it has been projected to lose money the next 12-month multiple negative 82. 2022 PE of 199, so above the peers. And one of the reasons, again, they're reinvesting a ton of capital. 126% of EBITDA has gone into CapEx compared to 173% in the peer group. These companies are just spending money, reinvesting, and that's for First Majestic, they had a record 2022 in production, but overall, it is an underinvestment space. I mean, I know that sounds counterintuitive to what I just talked about, but the statistics here: Peru's silver production is off 49.5% from the 2017 highs. Mexico's silver production is off 26.6% since the 2015 highs. Mexico is the world's largest silver producer, and Peru is the third largest behind China. This is an underinvested space. You've talked about this with energy before, and so that's another reason why we are very bullish on this stuff. Before we move on to the last Southern Copper Corp and the chart here, Jannis, on First Majestic, do you have anything to add here?
I would echo these points. As you said, you don't buy them because they're operationally excellent. You can buy other businesses as far as that goes. But again, the same way that crude oil traders watch pipeline flows and inventory levels, the same way metals traders watch those production numbers that you just alluded to here, with Mexico and Peru, two of the world's largest silver producers whose production has fallen off drastically, and that will in turn impact the way that silver is going to trade. So yeah, that's really the only thing that I'd have to add.
Great. We go get our chart here on First Majestic. It's not something to really write home about, but you got a lot of support down there. I mean, you got the big base, but I highlighted and said the base is the higher lows, and that's something really that's great. Still some downtrend resistance that it's running into, and it's still at the very low end here, given what silver's done. I mean, and if we continue to see strength in the metals, the underlying, First Majestic has a lot of room to run here. So that's what you got to take. That's a big takeaway there. You know where your risk is. We start breaking new lows on this move, break the trend line. Then I mean, silver is probably well below $20 at that time, and you want to get out of the way, or there's something more idiosyncratic with First Majestic itself. Let's move on to Southern Copper Corp. This is a company that is on our buy list right now, and as I pointed on the macro side, we a little fear the dollar could rally a little bit. You got some recessionary-like data. It's been what we would have thought more of a headwind. It's one of the reasons why we haven't bought Southern Copper Corp. Copper hasn't done a ton. The underlying copper futures have done, held really good ground, trading back above $4 at least for now. I mean, they're kind of retesting $4, but breakout. Look, I mean, why not? I mean, down from 23.6. It's a little more than the peers, but because they have one of the best pipelines, we have sustainable production, and you're really getting what could be a better company here. We think this is the potential better upside. The more performance of the stock itself is telling you that. Now, Southern Copper Corp is only reinvested 17% of its EBITDA compared to Freeport, 44%, and the aggregate of the peers is 38%. So you're getting a little bit of a better run business, and we're seeing what it's been able to do as well. Free cash flow yield at 24% is above its peers. I mean, this is a solid company. Then you layer how well it's been run from a balance sheet standpoint, layer that with the best pipeline, sustainable pipeline in the business. I think you have a really great company here, Jannis. What do you want to add to this? I know you like the stock a lot too.
I agree. So yeah, you have best-in-class mine life, best-in-class reserves, and after you had a lot of hiccups last year, just because you had a lot of strikes in Peru, they really have heavily invested there with a lot of their mines, and a lot of their copper production is coming from Peru. This year, you really see production pick back up as far as production data for this year is concerned. A lot of the utility companies in the region have reported that electricity usage is back up to where it was before the strike. So Southern Copper should be up and running here, surprising to the upside on production here in 2023. And then I agree, they have that mine life, they have those reserves, and as a result, they should have those sustainable cash flows. What we will watch this year is really, can they sustain those 2022 free cash flow yield levels or not? Because sometimes you could see some outliers there, but if they can sustain those high levels of 20+% free cash flow yield, then that would be really encouraging. And that's a direct result of the investment that's already happened in the past, and which is directly reflected in the mine life and reserves numbers. So yeah, watching this name, and then of course it all ties back into the China story, but also the greenification story, which we expect copper demand to double by 2035. Of course, all those net zero and whatnot scenarios are somewhat fluid, and you can never really be too certain as to where we're headed. But demand is most certainly going to trend higher than if you have China as the world's largest copper consumer, still to this day consuming 50% of the world's copper. You maybe see a little bit of a stabilization in real estate in China. A lot of the Chinese provinces have reported that construction activity, they expect that to pick up by 17%. So despite concerns about high debt levels in China, the CCP doesn't seem too eager to really tackle a lot of the systemic problems that are still there. But temporarily, at least, you do see that re-stimulation of the economy. You alluded to this in the introduction. China new loan data coming in extremely strong. I think the People's Bank of China is one of the few central banks that's actually stimulating its economy today compared to the other central banks around the globe. And then you have, the entire greenification story that I alluded to. But I think this is a solid company with solid mine life compared to peers with a higher multiple, because that's what you're ultimately paying for. If you look to the peers 12 multiple, this one about 21 on a 2022 comparison. So solid company, and it all hinges on what copper prices and what the global macro backdrop is going to do.
Great. Yeah, it's great stuff. Great ad there, Jannis. I mean, it's just a really well run company. And as we'll see here in this chart, as we pull it up, it's breaking out. I mean, this thing is breaking out. It held terrific support, retesting the post-pandemic, the pre-pandemic highs, held really well. And I just highlighted an area. If this fails, I mean, you really want to start seeing it hold that retracement area. That's a 50-week moving average. I think ultimately this consolidation is sort of whipsaw from technical basis, testing the breakout, back testing a little bit, and then you kind of get in this move here. This could be the makings of a really, really nice breakout. I mean, if you're trading this thing and looking to manage your risk just in that consolidation from that breakout in the past few weeks, that's your line to stand ultimately for this breakout. And we like the way this is really setting up here. Obviously, we told you a lot about it. So thanks a lot for joining us today. And there's a lot to unpack. As always, that chart book is terrific. Don't ignore it. Check it out and go through it on your own pace. Thanks for listening. We love to hear from you. Anything you want to see us cover in the future, any comments, any feedback, we just love to hear it. So thanks a lot for listening. Bill Baruch is the founder and CEO of Blue Line Capital. All opinions expressed by Bill and podcast guests are solely their own opinions and are not intended to provide specific advice or recommendations. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Understand your financial condition before investing. Blue Line Capital, its staff, or its clients may maintain positions in the securities discussed in this podcast.